Welcome everyone to the Daniel Krug and Associates Wealth Management Review for August 17th, 2023. My name is Rocky Eastfan. I am the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in this presentation. Our agenda: we've got a little bit of an economic update where we are here in August, look at some of the market indexes year to date, talk about the market strategy moving forward, and a final wrap up.
Okay. Well, we got a lot to go over in a small period of time, so why don't we just jump right in it?
Okay, welcome everybody. So good to see you. As most of you know, we track 25 leading indicators through City National Rockdale. And just a reminder, these dials represent the different aspects of the economy and financial markets. Anything that is green would be a positive trend in that economic indicator. Yellow would be neutral, red would be negative. And as you can see, as the economy has been slowing and the talks of recession, there's nothing green, it's mostly yellow and red. And it's been that way for a while. So just to let you know, though, we are starting to see a little bit of light at the end of the tunnel. For example, the U.S. economic outlook from last month to this month has continued to improve overall. The international economic outlook, you can see that internationally, the economic scene is a lot worse than it is in the U.S. However, we've seen some improvement there. And also, we've seen a significant improvement this year in inflation. As you remember, last year, the Fed started raising interest rates to counteract the inflation that a year ago, like June, we were over 9% inflation rate. Today, we're just under 4%, heading down still. But as always, that last mile of trying to get inflation completely under control is about the hardest to do. But good improvement has been made on the inflation front. When we look at U.S. gross domestic product, or GDP, we can see last year, and actually going all the way back to 2021, we were having very strong growth. However, the U.S. GDP is expected to slow going into the second half of 2023. But the good news, if you look at the middle of the chart, it remains and has remained positive. We currently came out of quarter two, the end of June, with about a 2.4% growth in GDP. However, you see the trend from 21 to 22, it is slowing. And then what we're forecasting on the right side of the chart is where CNR, City National Rockdale, believes we're going to be going into the end of this year. They're expecting around a 0.5% growth rate in the third quarter, and actually the economy bottoming out by the end of this year and being slightly negative in growth. So that's the first sign of any potential negative growth. But they are forecasting the remainder of 2024 to show some positive growth, and all that is boding well for the markets because what this looked like a year ago was much worse than what we were seeing in GDP as we're seeing today. So just wanted to point out again that we believe that the economy is going to be bottoming out towards the end of this year, beginning of next year, and starting to form some sort of recovery. Now, this is another interesting chart that we've presented before too, that City National Rockdale updates on a monthly basis. And what it does is it tracks the economic growth cycle. The economies expand and contract, they bottom out and then start expansion again. And you can see basically where we are right now and what the forecast is for the probability of a mild or deeper recession. And actually, these numbers have improved over time. So we saw a slight improvement. It was around 78% probability between mild and normal recession. That's down to about 74%. Again, due to rounding, these numbers aren't exactly perfect. But in essence, we're seeing less of a chance of a deep recession going into the end of this year and next year. So that's where we are from an economy standpoint, year to date.
And that's important because at the end of the day, we're looking for all the different economic indicators, all the different signs to give us an understanding of what is the next step. What do we do from a market standpoint to keep this strategy moving forward? So let's first talk about the market indexes. So I'm going to give you an update on the different indexes out there. And what it's going to show you is give you a little feel about what the broader market has been doing year to date. Now, before we talk about that, let's talk a little bit about the difference between capital weighted S&P 500 and equal weighted S&P 500. As you probably recall, the S&P 500 capital weighted is the most reported index measurement out there. And this is where the larger companies represent a larger percentage of the index versus the smaller companies in the S&P 500. Now, again, what did we say? We said that there is the 7 tech titans, you could probably throw an 8th in there, that are really driving the S&P 500 because they represent about 25% from a capital weighted standpoint of the returns. Now, going back to the equal weighted, what the equal weighted does is it's an alternative measure to look at the indexes, but what it does is it takes all the companies and they're all weighted the same from a percentage standpoint. And it gives you a better understanding of what the broader market is doing. So that being said, let's move forward here. If you look at the capital weighted year to date, and that green line kind of defines where 2023 starts, you can see that it looks like, wow, we've just been on a tear from the beginning of the year till August 16th. But the question is the whole market doing that? Now, if I move to the equal weighted, you can see a different story. It's at the beginning of the year, again, that green line, you've got the market that moved up and then it came back down and then it moved up a bit, then it came back down, and it's now in a downward trend. And one of the things I want to point out here is that squiggly green line that runs through the chart there, that is the 50-day moving average. And the 50-day moving average, once the stock market drops below it, that bodes well for continued decline in the market. And we're getting very close to the 100-day moving average. So if we break through that, again, likely it'll go down further. These are just, again, different indicators that we're looking at. If you look at the Russell Midcap, so this is all your midcap companies, and there's about 3,000 of them, you can see again, this is pretty much just walking sideways, and it too broke through the 50-day moving average. Russell Small Cap, generally small cap will lead out of a recession, it'll lead out of a market bottom. And it had moved forward pretty well year to date, but it also is making the largest correction right now. If you look at all those indicators, then you say, okay, well, if everything's still walking kind of sideways, and we do see a downtrend right now, because if you look at the beginning of July, we had a nice run up in July, we hit the end of July, and since we got into August, we've had virtually nothing but down days in the stock market. And we're talking about all indices right now. So how does that play into the strategy? First thing I want to do is I want to talk about what was the strategy, where did we come from, where are we today? And if you think about Q4 of 2022, in October, we actually hit the market bottom, and the market bottom was down over 26%. Now, we did have a little bounce at the end of the year where we ended up the year at down 19.5%. Now, move on to Q1. This is where we started step one of our strategy, which was basically moving defensive. And you'll find that in January and February, we started adding laddered treasuries to the portfolios. We added value portfolios, moving from growth stocks. We added high yield money market accounts at that point. And then from there, what was the next step? In 2023, as we're going into Q2, it was just a waiting game. And what we were asking our clients to be is patient, be very patient, because we've said it before, the market rewards the patient. It's those that jump without looking are the ones that end up losing in the stock market. So I want to put kudos out for our clients, because you guys have just been awesome relative to being patient in the market. So that was the strategy going really up to the end of Q2 of 2023. So what's changed? Well, what's changed is that now, you talk about what Mark or what Rocky had talked about, and that's the August economic indicators. First of all positive moves, no negatives. Second, from the gross domestic product, the GDP, ultimately, we're looking at a potential bottom in Q4. Now, why is that important? Well, keep in mind that the stock market bottoms, generally speaking, about 6 months prior to the economy or the economic cycle bottoming. So that now is a kind of a poignant time when you're looking at where are we in the market and what's moving in the market, which direction are we going? So now let's look at the equal weighted chart here, and we're going to talk a little bit about a dividend trend and what the market's been doing relative to dividends in the equal weighted S&P 500. If you look at these arrows represent the ex-dividend date for the S&P 500. And as you're probably noticing, every time there's a dividend date moving back the last 5 quarters, the market was either coming down or we hit the bottom in the market. Now, why is that important? Well, because we got another dividend date coming up, and we've got several indicators that are lining up at the same time. You've got the S&P 500 average moving 50-day moving average, which has been broken. You've got the 100-day moving average, which it sat on as of yesterday. We have the market trending down towards September 20th. And we've got the economic indicators, which appear at this point, we don't know what's going to happen next month, but it appears that we're slowing down a bit and we potentially could be close to the bottom in the economic cycle. So we say all that to say we still got to be patient. We've still got to wait for this to play out. The market is fickle. You cannot predict exactly when we're going to have a bottom in the market. And because of that, we need to just continue to be patient. But if things continue to line up the way they have been, then we will be ready to execute, to go back into risk, to move from a defensive position into more of a risk-on position, where the portfolios will either go back to your normal risk tolerance, or if the indicators lead us to do this, we may go more aggressive on the way back up again and then go back to the average client's risk tolerance as we're projecting forward here. Kind of exciting times right now, Rocky, because I'm a chart guy. I like charts. I like looking at all the economic indicators. Nobody likes it when the market's going down, but when you're going down in the market in anticipation to be able to pull the trigger to execute the next leg of our strategy, to me, that's exciting. So at this point, we all just need to be patient and let's see how this thing plays out.
Yep, sounds good.
All right. So we've got a great back office to help us execute. The goal is when we do pull the trigger that we want every client back to the portfolio in the next step within 3 days. And that's why we have a back office with AssetMark who can literally help make sure all trades are done at the same time or within a 3-day window. On top of that, keep in mind that if we are going to be doing Roth conversions for clients, that will be the time that we execute the Roth conversions as well. So this is just an update on where we are in our strategy, what the market's looking like with us. And, we're just it's still a waiting game. So everybody just needs to be patient, just like they have been. But we'll be watching it, and hopefully it plays out the way we believe it's going to. And hopefully there's not any major delays that create a hiccup here. But again, we can't predict the market. We don't know exactly when it's going to happen. We just have to be ready. So we do have solutions. And, if you come to our office workshops, watching the webinars, you all know that we are a full service wealth management firm where we're looking at investment solutions, cash and banking solutions, and trust services for our clients. We have a team available to be able to work with clients from a wealth enhancement standpoint, wealth transfer strategies, wealth protection strategies, and let us not forget, charitable giving strategies. And they all roll out to be a much better net rate of return for our clients as we move forward long term. So if you need to get more information, we've got a lot of videos on YouTube. All you need to do is go to our website, click on Watch Us, click then on DK&A YouTube, and it'll bring you right to that YouTube page. So you take care of your family, and
we'll take care of you. We're ready for the future.
Absolutely.